We will have now 10 minutes of questions, well, from the audience, from my own, if there's not any question. Oh, you already have there one question in the back, and one in the third row from the back.
You point out in your book that the biggest financial risk that's not being monitored is the transition of the Chinese economy from an investment model to a consumer-based model. Could you give us your take on the risk of China and how that is progressing, and how should we monitor that risk going forward? Thank you.
Okay, so what should we think about the Chinese economy? The Chinese economy, as I say, has gone through an extraordinary credit boom. In sheer quantity terms, this is even bigger than the Japanese boom of the 1980s or the US pre-crisis credit boom. I mean, to give you an idea, the Chinese economy is now a $12 trillion economy with debt to GDP of 250%. That is $30 trillion of debt, and the immediate sort of starting point of the last global financial crisis of 2008 was in the US residential mortgage market, which was about a 10 or 11 trillion dollar market. So the sheer scale of this Chinese debt pile in dollar terms is very much bigger than the debt piles that produced the crisis of 2008. That huge increase in debt has also been accompanied by a huge misallocation of real resources, what's called the incremental capital output ratio in the Chinese economy, how much new capital investment they have had to put in order to achieve each unit of GDP growth has gone over the last 8 years from sort of 3 to 6. They are wasting an enormous amount of capital. But they are stuck within a dilemma that you often face in the final stages of a credit-induced boom, which is they're terrified to cut it off and they're terrified to keep it going. They're terrified to cut it off because if they suddenly impose discipline, stop the banks lending new money, a whole load of provincial governments and corporates, particularly in the steel and the coal and the cement and other heavy industry sectors, will essentially be bankrupt. On the other hand, they're terrified of keeping the credit cycle going, because the longer they keep it going, the bigger the problem they'll eventually have. This is a very major concern, and I think the bit which is certain, and which is in a sense already occurring, is that this is going to produce a major slowdown in the Chinese economy, which has already occurred last year, and this is a major factor which has, over the last year, intensified the deflationary pressures across the global economy. It has driven falls in commodity prices, which have then had knock-on effects elsewhere. In a sense, we are already dealing with that. Will it also produce a global financial crisis? The answer is not necessarily, because at the moment, most of this debt resides between alternative parts of what is still a quasi-part system. Most of this debt is not to the Chinese private sector. It is from state-owned banks to state-owned enterprises, or from state-owned banks to local and provincial and city governments, or to various forms of off-balance sheet vehicle which are effectively vehicles of those city governments. Therefore, there is an optimistic case that what will happen is a giant bad debt tidy-up approach, which will involve large debt write-offs and the recapitalization of those state-owned banks, in the course of which a large amount of debt will essentially move from this quasi-private, quasi-state sector to become the formal debt of the Chinese central government. It will be another version of, once you've got too much debt, it doesn't go away, it moves around. But the good news is that the Chinese central government starts with a relatively low amount of debt. So there is a possibility that there will be a major tidy-up. I think this will unavoidably produce a depressive factor on the global economy. But it may not produce a financial crisis because most of it is not to the Chinese private sector, and most of it does not link into the rest of the world. International debt claims into China are not all that big. What would be really worrying is if this Chinese debt boom goes on for another 5 years, and if it is accompanied by a liberalization of the capital account so that an increasing proportion of these debt claims are linked in some way back into the global banking system or to debt funds which have invested in China, if that occurs, then in the early 2020s we could see a financial crisis which will make 2008 look like nothing. So what you have to hope is that over the course of the next 5 years, the Chinese authorities will do a giant cleanup of their financial system and will do it before they open up the capital account to liberal capital flows.
Let me ask you one question on our previous topic, on the first part of our conference. Would like to hear you on what are the advantages, if any, of a different balance between the public social security system being more balanced with also a private benefit defined system as you promoted or have in the United Kingdom. We've heard here the minister considering that it will not, moving in that direction might mean desocializing risk, rising inequality, and we've heard Encerramento quite right arguing that what the state is offering now is probably not adequate for pensions in the future. So how do you view this from the UK perspective?
I think the balance between the social security pay-as-you-go system and the funded element, it ultimately also has an element of politics to it. One of the things, and Professor Ferreira mentioned this earlier, is in several of my books I've argued that you shouldn't see, there are many questions which are not determined by a simple technical argument. They reflect political choices that societies can make within degrees of freedom. But typically, if you try to provide all of your pension system in a social security pay-as-you-go system, you can only do that with a level of taxes or social security contribution, and there isn't really much difference between taxes and social security contributions. We sometimes call them different things, but they have a lot of similarity. You may only be able to do it with an increase in taxes or social security contributions, which has a set of disadvantageous incentive or other effects, or just avoidance effects. And therefore, I think it makes sense to strike a balance. You can make a social security system, and it sounds to me as if you have done this in Portugal. I'm more familiar with the Swedish answer. You can make it formulaically responsive to increases in life expectancy by writing into it a formula whereby the retirement age within that system will increase with the change in life expectancy. I came across that in the Swedish system, and I'm a big admirer of it. And so you can go a long way in what people call parametric reform, changing the parameters of a social security. But all reforms have an element of private on top of that. And I think one just has to debate locally what is the correct balance. As I say, I think if you try and do it all by the social security system without a private system, you will probably end up with just a level of employer and employee contributions to the system which have some advantages, disadvantages in terms of total cost of labor, etc. But you can't do it all through the private system either. I think it is literally a matter of balance, and each society has to debate its own balance as to how to get that right.
Thank you. I think we have time for one more question. I don't know if in the audience anyone would like to have the opportunity to. We have one question there. May I ask you please to introduce yourself? Sorry.
Hi, I'm Fatima Lima. I would like to say first that coming to Lisbon in the middle 40s is not so bad.
Sorry.
as it seems.
Either it's not working or you're not close enough to the microphone.
Sorry.
Okay, perfect.
Sorry. My name is Fatima Lima, and I would like to start to saying that coming from the first time to Lisbon in the middle 40s is not so bad, as it seems. And the second question I would like to say is, do you think that it will be possible to find a solution for debt similar to those found to UK pension system? That is, meaning better risk sharing between money creation and private debt policies?
To which? To the...
I think we have basically two options regarding that: money creation versus private debt.
Yeah.
And I
Can we get an optimal solution? Yeah.
Yeah.
Okay. I think that the optimal solution requires, in the upswing of the crisis, far stronger constraints on private credit and money creation than were in place before, and in particular, stronger constraints against private credit extended for the purchase of existing assets, in particular real estate. Now, clearly there is an economic function for a residential mortgage market and indeed for commercial real estate lending, but I think we should just be much more cautious about it. We should constrain it in the upswing of the cycle. If you haven't done that, and you end up in a deflationary trap, a debt overhang trap, I think you have to create a discipline structure which gives you the confidence that you can use money creation to get out of that problem. And the discipline was precisely described by Ben Bernanke 2 months ago in a blog for Brookings Institute, when he returned to the fact that we sometimes need money finance, and he addressed, as I do in my book, the issue of how do you do that in a disciplined fashion? How do you stop governments doing too much? And I think you stop governments doing too much by locating the decision on how much is appropriate within an independent and inflation-targeting central bank. What he said in relation to the US is there is no theoretical reason whatsoever why the Federal Reserve, governed through the Federal Open Market Committee, in addition to being given independent control of interest rates, should not have within its statutes the ability to say, we now think we're in such a deflationary trap that we believe it would be good for the government to do a one-off stimulus of $50 billion, which is permanently financed with money that we will create. And for the Constitution to allow that that $50 billion would be financed by money creation, but not $51 billion, because the FOMC had not decided that. And I see no reason fundamentally why, if we have been able to take the control over interest rates and to hand it to inflation-targeting central banks, confident that they will move those interest rates up and down in an attempt to hit an inflation target, I don't see why they shouldn't be able to approve the use of another tool. I think we can locate it. So do I want governments to be able to stand up and say, I've decided to have 50 billion of money finance. Central bank, I'm giving you the instruction to send me the money. No, I think that is very dangerous, but I think we can construct a new discipline. Now, I have to say, and this is one of the things which I find most difficult and where I'm least optimistic, is that the most difficult place in the world to construct such a discipline is the Eurozone. I think actually, in relation to the Federal Reserve, the Bank of Japan or the Bank of England, it would be relatively straightforward for us to construct that discipline, and I think we should do so. Because we are dealing there with one fiscal authority and one monetary authority, and both of those are responsible to one nation, one populace, whose interests they are trying to serve. The huge difficulty in the Eurozone is that the moment you start saying the ECB should fund a helicopter money drop, i.e. should print money, which is then spent on infrastructure or given away as a tax cut, you get, to whom is this tax cut going? And where is this infrastructure going to be built? And I'm a German taxpayer, and I don't want you giving money to those Greeks and Italians or whatever. And that is a major constraint. And I have to say, one of the things that really worries me in the world is that I think it is in the Eurozone where there is probably the greatest value today in having a money-financed fiscal stimulus and the greatest need to. But I think it is the area where, because of the complexity of the Eurozone system, with one currency but multiple governments, it will be most politically difficult to end up achieving with an agreement. While, therefore, I think that in Japan, we are de facto seeing in front of our face a permanent debt monetization exercise, even while the government and Bank of Japan continually deny that one is occurring. And while I'm completely relaxed about that, my concern in Europe is that Europe needs it, but it probably won't occur.
Thank you very much. We are closing our session. Before that, we will have Professor Paz Ferreira having the last words. And Lord Turner has kindly accepted to be here for a few minutes autographing the books you have with you. So in the end, please do come up here, and you'll have a few words written on your book by Adair Turner. Professor Paz Ferreira, please.
Oh, thank you. It was a splendid morning. I think it's the common feeling, and we were delighted, obviously, to listen to Adair Turner. And, well, I think we'll keep on thinking about these provocative ideas and these initiatives that could be taken to solve our problems. This last confession of the difficulties in the Eurozone obviously is a dramatic case for us, because I do really agree that it could be the easy point to do it, but with this construction, completely impossible. So thank you so much.
Thank you.